After 30 years in markets, we have learned one uncomfortable truth: the stock market rarely defeats investors. Investors usually defeat themselves. They buy excitement after prices have soared. They sell fear after prices have collapsed. Market does not need to take their money. Their emotions often hand it over. The pattern is almost always the same. They trade too much, buy yesterday's winners, sell winners and keep losers. Mistake concentration for conviction, and enter the market without a plan. Not every retail investor loses. Patient investors with diversified portfolios can build real wealth. The problem begins when people expect quick profits instead of gradual compounding. The real enemy is not volatility, it is behavior under pressure. Many retail investors believe activity means intelligence. In markets, activity and progress are not the same thing. Frequent trading creates more opportunities to be wrong. It also creates bid-ask spreads, taxes, and hidden costs, even when commissions look like zero. One major study of more than 66,000 brokerage households found that the heaviest traders earned 11.4% annually, while the market earned 17.9% during the same period. Trading feels productive, but in investing, the quiet discipline of doing less can be far more powerful. Retail investors often discover a stock only after it has already made headlines. A rising price creates excitement, social media attention, and fear of missing out. This is where investors confuse a great company with a great investment at any price. The latest proof is the AI and memory chips boom-bust cycle. When expectations become unrealistic, even strong profits can disappoint the market. The late buyer suffers, while the early buyer takes profits. Many investors sell profitable positions too quickly to feel successful, but hold losing positions to avoid admitting a mistake. This is called the disposition effect. The market does not care what price you bought. Your purchase price is emotionally important to you only, but irrelevant to the market. The correct question is not, am I making or losing money? It is, would I buy this investment today at its current price? Successful investors are not right all the time. They survive because they refuse to let ego control their capital. Owning one fashionable technology stock, one speculative biotech, or one cryptocurrency can create wealth, but it can also destroy it. Retail investors are often drawn to familiar names, glamorous stories, and assets that feel exciting. Investor research identifies under-diversification, familiarity bias, and excessive preference for glamorous stocks as behaviors that damage portfolios. Real diversification may feel boring. That is precisely why it works. No single mistake should be able to ruin your financial future. Many people buy without deciding why they are buying, how much they can lose, or what would make them sell. When volatility arrives, emotion replaces strategy. Leverage makes this worse. Borrowed money, margin, and derivatives can turn an ordinary decline into a deeper loss. A good company may eventually recover. A leveraged investor may not survive long enough to see his profit. Successful investing is usually less dramatic than people expect. Build a diversified portfolio. Keep costs low. Avoid unnecessary leverage. Invest long-term, with a time horizon measured in years, not days. You cannot control interest rates, earnings, or tomorrow's market. You can control what you buy, the price you pay, how much risk you take, and whether panic makes the decision for you. In the long run, temperament and self-control are often more valuable than intelligence. Markets will always create fear and excitement. The investor who survives both has the advantage. The difference between speculation and investing is not the asset. It is the behavior behind the decision. The market is not easy, but it is far less dangerous when you keep fighting against yourself. Tell us in the comments, what do you think is the biggest mistake retail investors make? If you want premium investment, business, and financial intelligence, subscribe to the Global Ledger. Until next time, follow the intelligence.